process. And I want to now introduce Mr. Engineer Atter Hanoura, who is a PPP expert with a lot of experience on PPPs, both internationally with USAID and the World Bank. And since 2007, he was appointed by the Ministry of Finance of Egypt to be the director of the PPP Central Unit. And in that capacity, he has been responsible not only for drafting the national PPP legal framework in Egypt, but also for making so many of the important PPP operations in the country to take place. So with that, it is my great pleasure to invite Atter to tell us a little bit more about the experience of Egypt on how to handle all of these risks in that process. Thank you, Atter.
Thank you, Eddie. Thank you, everybody. Actually, today we'll be addressing some of the financial risks that we faced during our implementation of the PP projects. As Egypt, as you know, it's a middle-income country where we face a lot of financial risks over the last 15 years, and we faced a lot of revolutions and political instability, economic instabilities, high fluctuation of interest rates and FX rates. So I'll tell you some of our experiences and how did we succeed to overcome it one way or another. Next, please. Victoria. The financial risks, actually, as everyone knows, is when you have some kind of uncertainties or potential adverse events that would impact on the financial performance of any project. And to manage these financial risks, we have to do some risk assessment, appropriate risk allocation, as we all know, and procedures to mitigate such risks. And all this part should be done during the project preparation. Risk assessments, quantification of risks, appropriate risk allocation, all that this is the structure of the project which is coming out from the studies and during the project preparation. So this would ensure that the implementation of the contract or implementation of the project throughout the tenure of the project or the period of the project is much more smoother. The effectiveness of this addressing these financial risks actually is very important for the financial viability and to attract investors and banks. So the banks turn to be, or the project turn to be bankable, and to, as I mentioned, that the project could be easily implemented and the contract could be efficiently managed. Next, please. Some key categories of the financial risks, traditional financial risks, are the interest rate, the exchange rate, foreign exchange rate, inflation rate, credit risks, revenue risks, refinancing risks, a lot of operational risks as well, construction risk, and this is normally the private sector responsibility. We also face force majeure risks and legal risks, and this and political, definitely, and regulatory risks, which have a direct impact on the financial equilibrium of the contract or the project that should be addressed. Today, we'll be only addressing three categories of these financial risks, as we mentioned before, which is the interest rate, exchange rate, and the inflation. To address this kind of risks, we have to do some kind of indexation. So this means that the payment or the fees or the cost of service should be indexed, should be revisited to overcome this adverse impact of any of these financial variances or the financial risks. So to adjust the payment and any other financial aspects, and any financial variables, let me say, throughout the project. The indexation mechanisms are typically specified in the contract, and this is very important. It should be put not in a conceptual way. In the contract, we have to put it in a term of a formula or an equation. So you can just substitute this equation or this formula, and it comes out with the adjusted payment or the adjusted fees to avoid any kind of dispute between the two parties, the public and the private. I will start with the interest rate indexation. Normally, when we started our PPs in 2006, 2007, and we took our experience from European countries, by that time, only Europe was moving heavily in the PPs. The usually procedures or the usual system, and we've practiced this in 2006 to 2007 throughout 2010, that the private sector factor in his pricing the interest rate. And we asked them to do this, and we faced one major problem. The major problem here was the tenor of the loan. We were using the local currency, so the payments were the local currency, and it's very much preferred for the investors to use loans in local currency. So they have to factor in its interest rate. The problem was the tenor. The banks by that time, the Egyptian banks, the local current banks, did not provide long tenors. And this is one of the major problems that we face in a long project like the PP project, which is 20 years, 25 years, maybe 30 years in sometimes. The problem was this bank cannot fix interest rate for more than 7 years. In some rare cases, it can go up to 10 years. And we need 18 and 20 years tenors. So to overcome this, we came with a variable interest rate. The advisory companies and the advisory teams came to us with the solution of put the interest premium over the LIBOR or the Euribor, or as in Egypt, we call it the corridor. And this actually, in the implementation, made a major problem. Because in each payment, in each month, or each quarter, you have to readjust the payment and readjust the the fees or the service cost of service as per the interest rate, which is moving every month or every 3 months. Okay, and this is something that was not accepted from the implementers, actually from the government side, because this is a lot of calculations, a lot of burden on the accounting system. So we went through fixing interest rate. Actually, what we're doing now with interest rate, given that the interest rates are in Egypt, that's why the banks are not able to fix it for a longer tenor. It varies from 8%, 12%, 17%, goes down to 12, up to 14, back to 21, 23, as we're having the interest rates now, unfortunately. So the big variation does not allow the banks to put long tenor with a fixed interest rate. So actually, we changed the system of the contracts and the bidding. We asked the private sector to put in his financial model, which he submits to the government, the interest rate that he agrees with the banks on, and price accordingly. And in the contract, we visit the interest rate every year. So the only thing that he needs to do is to agree with his banks to fix the interest rate for 1 year. In earlier 2010, 2009, and this before the revolution that we faced, we used to fix this rate for 3 years, and to fix it, to link it with the 3 years CDs. Now, given that the variation is high, and actually the interest rate is moving quickly, as you see in the dollar and the euros interest rates are getting very high, and the interest rate in Egypt actually is reaching 23, 24 now, with the jumps of 200 basis points and 400 basis points in one jump, which is a very high risk on the private sector. So we came that the private sector will put his initial interest rate that he agrees at the financial closure in his financial model, and this would adjust the payment that the cost of the service that he's putting in his bid, and this will be revisited every year, and we will adjust the payment accordingly. If the base interest rate increases by 1 or 2%, we'll apply this 1 or 2% on the outstanding debt. Okay. And if it decreases, then we'll apply this decrease, and accordingly, the cost of service will increase or decrease with the portion of the interest rate. So we're only taking the risk of the 1 year. Given that we have very high interest rates now in dollars or in euros, or very extremely high rates on the Egyptian pounds, so we made it instead of 3 years, 1 year. Okay, so we can revisit it every time. The last thing I want to say in this aspect is, what if we enter this fixed year with an interest rate of, for instance, 10%, and then 2 months later, the 10% is fixed throughout the year. 2 months or 3 months later, this interest rate dropped to 7% or to 6%. In this case, in our contract, we say that the government have the right to ask or to urge or to push the private sector to refinance, okay? And the gains of this refinancing is shared between the private sector and the public sector. Definitely, the last thing I want to say here is that this interest rate is affecting the capex part or the capex portion of the payment of the service payment. Next, please. Yes. Adjustment of the interest rates, actually, an initial adjustment or interest or for the interest rate changes will take place on the effective date of the contract, based on the terms of the financial closure, as compared to the financial model submitted by the project company when they submitted their bids. This is applicable on the outstanding senior debt, because this will be done through over the tenor of the loan, which is 15 years or 20 years, depending on the project. The interest rate adjustment, the outstanding debt multiplied by the benchmark interest rate, which is the initial interest rate that he priced up accordingly, minus the interest rate at the bid submission date. And then we apply the difference either by the negative or the positive to the outstanding debt. And actually, to get the new cost of service, we apply this interest rate in the financial model that's approved for this project, submitted for this project. Next, please. Inflation rate and inflation indexation. This is something that I have to give you our experience in. When we started tendering our first projects in 2007, we had advisory teams, very high, reputable advisory teams coming from Europe. And they were pushing us to do this project. It was a wastewater treatment plant where the government is the off-taker and the government is paying for the service. And they want to introduce something called the unitary payment. The unitary payment is a fixed fees for the service, cost of service, that will be paid throughout the project lifetime. So, for instance, if it's $1 or £1 or €1 per cubic meter of treatment, then we will be paying this unitary payment, this fixed rate, or this $1, or this £1 throughout the 20 years of the project. So after 10 years, we'll be paying £1. After 15 years, we'll be paying this £1. And this unitary payment is a fixed rate throughout the project. This means that the private sector, to give you this in his bid, this unitary payment, he have to factor in the interest rate, factor in the inflation rate. And this was applicable sometimes in Europe and USA and the high income countries, because the inflation rate by that time is moving through an envelope of 1% to 2.5% or 2%. So you can easily take an average of that and factor it in your price. Actually, when you start doing this, I didn't agree with them on that, because I'm coming from the private sector and I know how I was using this, or how I was factoring this. Actually, in Egypt, the inflation rate is varying very high. So we can start with 11%, 12%. We can go to 17%, to 19% the next year, and then the year following drop to 14, drop to 8, come back to 14, to 17, reach 30. Especially in the last few years, we hit the 40 or 45 inflation rate actually in Egypt. So this is a big variance. What I used to do is to draw this graph, split it into two, and take the average of the upper part. Okay, so I factor in my pricing in 20%. Okay, so if the inflation drops to 18 or to 12 or 13, the government will be paying this 20% because it's factored in the price. So we didn't agree on that, and we asked the private sector to put his price based on zero inflation. He captured the cost of the date of bid submission, and he should not put any inflation on his pricing. And the government, or the public sector, we will be calculating the actual inflation per year and add this inflation on the cost of service. Okay, and I have to mention something here, that this inflation is not affecting the entire payment, is affecting the operating charge, or the operating cost of this part. So for instance, if the unit price is 10 pounds or 10 Egyptian pounds, for instance, and this 10 pounds is 70% towards capex and 30% towards opex, operation cost, then the inflation rate is applied on the operation cost, which is the 30%, which is the 3 pounds. And this actually are clearly stated in the tender document and in the draft contract that we submit with the tender document. Next, please. The indexation mechanism of the inflation. We have to have the base index, which is typically, usually it was the consumer price index, or if you choose to have the producer price index, you have to have a base index, and you have to identify in the contract the source of this index. Annual adjustment commencing from the first year following the service commencement date. But I want to mention one thing here. The payment starts from the service commencement date, but the inflation calculation starts from the day of bid submission, because at this day, he cannot change his price anymore. We have 1 year for evaluation and financial closure, maybe 2 years for construction, and then the service commencement date. This 2-3 years, who will be paying the inflation rate? That's the government responsibility. So we adjust the inflation rate on the OpEx part. And we start calculating from the date of bid submission, paid on the bid commencement date, as we are adjusting the the service cost or the service fees. As you can see this is a simple formula. The adjusted operation cost is the base operating cost, okay, which is in his bid, multiplied by the current index divided by the base index, inflation rate. And as I mentioned, we started from the bid submission date, and it is accumulative year after year or year over year, as is normally said. Actually, this, when we applied this inflation rate in the very early years of operation of PP operation in Egypt, is 2007. This actually, a lot of investors encouraged to come into this market, and actually we have higher competition and better cost by the end of the day. Next, please. The FX rate, the exchange rate. And the exchange rate, I want to tell you that there is no single formula or no single methodology to address this interest rate, exchange rate. And it depends on the economical situation of the country. And it changes from time to time, even with the same country. In the foreign exchange rate affects the entire payment. As I mentioned, the interest rate affecting the capex, the inflation affecting the OpEx, the exchange rate affecting the entire payment. Because there's more than one methodology to address this. Number one, as we normally started, the interest rate, or the foreign exchange rate is the responsibility of the private sector. He is lending, he's borrowing from banks, and he's putting his equity, and he has to factor all this and factor any hedging that should be put in his pricing. Given that economical situation has been changing, and we faced after the 2011 revolution, 2013 another revolution, and the changes of the economical situation in Egypt, and the fluctuation of the foreign exchange risk, the foreign exchange rates, and the devaluation of the Egyptian pounds that happened twice or thrice over these years. Actually, there was a very high risk at the private sector to price their, as usual, in Egyptian pounds. And in this case, we actually used three different methodologies in three different periods over the last 8 years or 9 years. We started by splitting the payment or the fees into two portions. Part of it in Egyptian pounds or the local currency, and the other portion in US dollars or euros. Okay, and this separation is done through the capex foreign currency component of the investment cost in the capex. So if a project like a wastewater treatment plant or a desalination treatment plant, actually it requires to import some equipment with about 30% or 40%. So this is his risk. This is the foreign exchange risk that they have to mitigate. And the rest is in Egyptian pounds. So they can lend or they can borrow in Egyptian pounds from the local banks, the rest. So this payment, for instance, is a 10 pounds. We say that this 10 pounds, 6 pounds paid in Egyptian pounds, and the 4 pounds are equivalent to 10 cents. So we pay to the private sector in Egyptian pounds and in cents. The payment in dollars here was due to two main risks. Number one, unavailability of US currencies or foreign currencies in Egypt by that time. The second thing, by that time, something like 2 years back, there was a very big difference between the official exchange rate in the banks and the parallel market or the black market as we used to call it. And sometimes it exceeds 60% or 70% difference. And this is a very high risk. So we have to tell him that we are paying to you this portion in US dollars or in euros to mitigate this risk. And accordingly, he can repay his foreign debts to the banks like the World Bank or the Asian Development Bank or any IFI that took some foreign currency to finance the project. Recently, we've changed the system. The price is still split it into Egyptian pound portion and in US dollar portion, reflecting the dollar component of the capex. But now because we have a different structure in the banking system, and the Central Bank of Egypt already something like in last March announced that a full liberation of the exchange rate. So there is no parallel market, there is no black market anymore. The banks already can price based on the demand, so there is no parallel market, and this risk already disappeared. So we told them that we will be paying in Egyptian pounds, or the cost, the price will be priced in Egyptian pounds and US dollars, but the US dollars will be paid in Egyptian pounds as per the exchange rate of the day of payment. Okay, so the entire payment was done in Egyptian pounds, but there's a portion evaluated in US dollars or in euros. Last thing in this issue I want to tell you about, because we faced it in our projects. As you know, that the PP projects is either government pay, where the government is the off-taker, okay, or user paid, like the tolls or the like in ports or airports or whatever. It's the services delivered to the beneficiary, and the beneficiary pays the cost direct. It's a user pay. So when it's the government pay, the government is paying portion in dollar and a portion in Egyptian pounds. Okay, it can do this kind of indexation. What about the user pay? The users normally pay in the local currency. I cannot do this to any project that is based on a user pay. When a toll, you cannot tell him pay 10 pounds and 2 cents. He cannot do this. So we treated this in our contracts that in such cases, we as a government revisit the fees and allow him to increase or readjust his the user cost or the fees to absorb this changes in dollars that he can still, he have to pay, the service should be paid to him in local currency. Sorry for being a little bit long, and
no, Atter,
I'll stop.
it was fantastic. Great comments in the chat room function. And just to confirm that this will be all videotaped and shared. Couple of questions that came in the conversation, very short and practical. You mentioned that when the interest rate went down, then the government would push the private partner to refinance, and the gains were shared between government and private sector. The question were, how were they shared? Half and half, or what portion? And the second was, how are you handling the issues of convertibility risks? And what advice would you give to countries where Sometimes they go through a period where it's not easy to convert the local currency into foreign exchange currency. How to deal with those convertibility in the process, and you face some of that. You mentioned the black market. You mentioned constraints into that process. So, how to share refinancing, what to do with convertibility.
Okay. The first question was the portion of the refinancing. Actually, we started 10 years back by sharing this 50-50. Now we're doing it a little bit different. We share it 75% for the government, 25% for the private sector after all kinds of costs. There is a cost of refinancing. So we deduct the cost of refinancing and the gains are split at 25-75. The private sector has to have some kind of incentive to do this kind of refinancing. The convertibility. As I mentioned, there is no one fixed solution for this dealing with the foreign exchange risk. However, in Egypt, we gain a lot of experience because in the last 10, 12 years, we faced everything that should happen in other countries in over a century. So we have the convertibility issue here. You need the convertibility for two cases. Number one, for the private sector, I'm putting myself in the private sector, getting his money in the local currency or the Egyptian pounds, and he wants to pay his debts or his loan in foreign currency, or to do some kind of repatriation for his profits to his mother company somewhere in another country. The solution here depends on the case or the situation that you have now. When we faced a black market, and the difference between it was 30 pounds in the banks, and it was actually 60 something in the or 54 pounds in the black market. This black market actually reflects one major issue, reflects that there is a shortage in the foreign currency in the country. And this shortage, actually, the central bank is facing this problem. Banks, commercial banks are facing this problem, and accordingly, the private sector. Okay, we work this with the cabinet, with the prime minister, and the central bank of Egypt to give some kind of priority for the PPP projects, to allow the banks to put them in the priority list, so the banks can provide them with this kind of payment. Okay, this portion, let me say and repeat, the portion of the dollar component. Please, the entire capex is not in dollars. The entire capex, especially in the low-income countries and the medium-income countries like ours, you have to split with the local currency because the local currency risk is much more less. However, the interest rate is high, and you have to accept this in pricing and minimize as you can the local component. Thank you.
Atter, thank you very much. Super practical, much appreciated. Just to confirm, several people have asked whether the presentations will be shared as well as the videos, and yes, both will be shared.